They called it a correction. Every financial headline, and from New York to London, framed it that way. A healthy pullback. Profit-taking after an overextended rally. The kind of move that happens when a commodity runs too far, too fast, and the market simply exhales. That's the story they printed. That's the explanation they handed to retail investors who watched silver collapse. 44%. From its January all-time high of 121.64 down to roughly 67 in under 60 days. A correction. Except corrections don't drain our enough buyer. 80% material shoot on execution of a major exchange's deliverable inventory over 4 years. Corrections don't force 10-hour emergency negotiations to settle contracts in cash because the metal doesn't exist. Corrections don't split the global market into three isolated islands. And where the same ounce of silver trades at wildly different prices depending on which continent you're standing on. What happened to silver is not a correction. It is a kokikoi, controlled demolition of the paper pricing system, and the wreckage is still falling. Intro. This is OG John AG. If you're new here and you want the kind of data that never makes it onto financial television, subscribe now, because what I'm about to walk you through is going to change how you look at every price quote you see for the rest of this cycle. Section 1. Surface level price action. Let me start with the price action on the surface, because understanding what the screen shows you is the first step toward understanding what it hides. As of the scene, pointing 27th of March 2026, silver settled at 60 ambin, 97 per ounce, up 22 cents on the session. Unremarkable. Quite the kind of day that makes people scroll past the precious metals section entirely. But look at the week in sequence. On the Saturn, 20 night, and silver sat at 69 to 39. By the time 24th Friday, it climbed to 70 points. There to tomorrow brought 7 to 60 got a $2.47 jump. Then on the scan quantities, mustn't kapiki matwaxikin murder or one seek to a single session plunge of Darn or more full tire fun pressure dragged it back to I mean or 67 even or some. Nearly 7% intraday volatility in what the press calls a stable asset class. Zoom out further. In the first week of March, silver was still trading above 80 following. By mid-month, a geopolitical shock, which I will detail in a moment, compressed it into the upper 60s, and the widest lens tells the most unsettling story of all. In late January 2026, silver touched an all-time high of 121.64 per ounce. It now trades Paintada of 44% below that peak. A drawdown of that speed and magnitude doesn't happen because people decided to take profits. It happens because the mechanisms that control price in the paper market are operating independently from the mechanisms that control supply in the physical market. Section 2. COMEX inventory. The number that matters most. Now let me take you underneath the price to the number that matters most, because everything else flows from it. COMEX registered silver inventory, the money-only stowed category of metal that can actually be delivered against futures contracts, has declined 11.9% in the last 30 days alone. 10.3 million ounces pulled out of the vaults in a single month. The coverage ratio, into which measures deliverable silver against outstanding paper claims, sits at 13.4%. Below 15% is stress territory. We are not approaching stress. We are swimming in it. Paper leverage has reached 7.5 times. Meaning for every single physical ounce sitting in a registered vault, 7.5 ounces of paper promises are circulating through the futures market, pretending to be silver. And the clock is ticking on the next test. April 2026, first notice day, arrives in 2 business days. 126 contracts and contracts are still open. That is 8.6 million ounces. Someone needs to deliver. or roll. At the current withdrawal pace, every ounce of registered silver on COMEX would be gone in approximately 163 trading days. Not years, trading days. Pull those numbers apart and the trajectory becomes even more alarming. By late February, registered silver dropped below 90 million ounces, landing at 191 million. So you can eat 32% decline free now. In just 4 months, total COMEX inventory, which includes eligible metal not available for delivery, fell from 532 million ounces. In October, the giant attacked them 306 million. By the same period, a 31% drop was Siko. On the 11th of February, a single session was equal to 257 million ounces, withdrawn from registered, and another might tell me 47 million city. Pulled from eligible, nearly torne. 8 million ounces vanished from the system in 24 hours. That was the day registered silver broke below the psychologically devastating 100 million ounce floor. And from a longer view, registered inventory has now collapsed over EMEA, 80% from its 2021 peak. Every previous drawdown in COMEX history reversed when prices rose high enough to coax metal back into the system. This one has not reversed. It has accelerated. Section 3. March delivery. The verdict. March was supposed to answer whether the system could absorb this kind of pressure. The answer arrived with the force of a verdict. On first notice day for the March contract, delivery notices were issued for 10,526 contracts, representing approximately 0.63 million ounces. So that delivery demand consumed more than 60% of total registered inventory in one cycle. For context, January 2025 and years prior typically saw delivery demand of 1 to 5 million ounces. January 2026, a non-major month, processed 33 to 40 million ounces in a Mairai. That is a kamikino, 7 to 10 times increase over the historical baseline. The entities standing for delivery are not day traders looking for a quick flip. They are industrial buyers, sovereign entities, and physical dealers, who have lost faith in the paper market's ability to deliver what it promises. Section 4. China's strategic reclassification. Now, here is where the architecture of this crisis shifts from domestic to global, and where the story becomes something no mainstream outlet is willing to frame honestly. On the 1st of January, 2026, China's Ministry of Commerce officially reclassified silver as a dual-use strategic material. The same designation applied to gallium, germanium, and rare earths. Every Chinese refiner now requires a special government license to export silver. Export volumes have been reduced by up to 40% compared to the previous year. The licensing framework demands a minimum annual production of 80 tons and $30 million per annum. And in credit lines, effectively locking small and mid-sized firms out of the international market entirely. State media cited an unnamed industry insider confirming that this policy places silver on the same regulatory footing as rare earths. So this is not a tariff. It is not a negotiating tactic. It is the Mokuriwimaisi permanent reclassification Doris. Taking of silver from an ordinary commodity into a weapon of Marikomatsu. Some resource sovereignty. And it has fractured the global supply chain in ways that cannot be repaired by diplomacy. Section 5. The three market fracture. The impact was immediate, and it has not faded. Physical silver in Shanghai now trades at a persistent premium of $8 to $13 per ounce, above New York prices. At its widest, the premium exceeded 12%, preferring over the London spot price. Think about what that means for a moment. The same physical element, the same atomic weight, the same industrial utility, priced down to 12% higher in one city than another, because paper markets in the West and physical markets in the East have decoupled. On the 2nd of January, the COMEX March contract closed at 72,000. That same day in Dubai, the cheapest retail silver coin available was on Tiden Sada Kep 999 a Kebmarine 38% divergence so between the paper quote and the physical price. In a functioning market, arbitrage erases that gap within hours. Traders buy where it's cheap, ship it where it's expensive, and the spread collapses. This gap has been open for months. Because the arbitrage mechanism depends on silver flowing freely across borders, and China ended that flow on the 1st of January. The consequences extend beyond price into the real industrial economy. Major technology corporations and solar panel manufacturers are reportedly attempting to buy directly on the Shanghai Gold Exchange and import metal through circuitous routes at exorbitant costs. Samsung has finalized BAMI direct offtake agreements with primary silver producers, bypassing COMEX and LBMA entirely. The era of just-in-time silver supply from exchange warehouses may already be over. Section 6. Why did the price fall 44%? But if the physical market is this tight, if delivery demand is this overwhelming, if China has walled off the world's largest refining capacity from Western buyers, then why did the price fall 44%? That question is the hinge of this entire story. And the answer is not one thing. It is three things happening simultaneously, each amplifying the others in a cascade that made the crash look organic, when it was anything but. Force 1. Margin. In late December 2025, CME raised silver futures margin requirements from 22,000 to 25,000 per contract, a 14% increase. On the 30th of January, margin parameters climbed again, from 11% to 15%. Each silver futures contract controls 5,000 ounces. At 75 per ounce, that's a 375,000 of exposure, backed by a $25,000 deposit, 15 to 1 leverage, with approximately 4,000 contracts. Open, the margin hike injected a demand for roughly 675 million. I'd see an additional collateral. Overnight, traders who couldn't meet the call were forced to sell. Silver dropped approximately 11% intraday. Then the cascade deepened. In late January, silver crashed roughly 27% in a single session. A liquidity event where leverage, positioning, and headlines collided. This is not new. In 1980, the Hunt brothers were broken by margin hikes and rule changes. In 2011, 5 margin increases in 9 days killed silver's run from $49. JP Morgan's precious metals desk was found to have engaged in spoofing and manipulation spanning at least 8 years, involving hundreds of thousands of fraudulent orders across precious metals and US Treasuries. The settlement was 920 million $. That is a federal enforcement record, not a theory. Force 2, the data center shutdown. On the plunged, down 27th of November 2025, as silver approached 54. During Asian trading hours, CME markets were halted due to a reported cooling failure at the Fuskja on Cyrus 1 data center. In Aurora, Illinois, silver was at a price level representing severe exposure for institutional short positions. A cybersecurity professional who analysed the incident publicly concluded that the evidence favoured a high strategic intervention, designed to prevent a catastrophic short squeeze over a genuine infrastructure failure. Whether that conclusion is correct or not, the timing remains difficult to explain by coincidence alone. And on the free nose, 30th of November, COMEX was unable to fulfill a block delivery demand of 330 contracts. At 10 hours of emergency negotiations ended with 816 contracts, settled in cash at a premium of $65 million. Not in silver, in dollars, because the silver did not exist in sufficient quantity to hand over. Force 3. War. Not a distant contained regional conflict. A direct military confrontation between nuclear-armed alliances in the most energy-sensitive corridor on the planet. On the studio at Eden 28th of February 2026. US and Israeli forces struck over Heim. 2,000 targets are Amachdi inside Iran, including the Natanz nuclear facility. Supreme Leader Khamenei was reported killed on the first day. Iran retaliated with missile strikes against Israel, Lebanon, and Gulf states, including the UAE, Qatar, Kuwait, and Bahrain. Gold surged past 10,400 dinar. Silver hit. The initial move was textbook safe haven buying, then the reversal arrived with brutal speed. On the classy 19th of March, Iranian retaliatory strikes on energy facilities in Qatar, Saudi Arabia, and Kuwait sent oil prices surging and triggered a Mexico 5.9% single-day crash in gold and a 8.2% collapse in silver fight. The Strait of Hormuz, through which Moniti Nawai 20% from Sikawai, acts of global oil passes, Mikaun Frefina Card, or Taisuban became an active conflict zone. Central banks responded not with rate cuts for Nigamit, but with hawkish resolve, treating energy-driven inflation as a primary institutional threat. The Federal Reserve signalled the assumption that central banks would always cushion falling asset prices, what traders call the Fed put, evaporated. Gold stopped functioning as a safe haven and became a source of emergency liquidity. Traders sold metal to cover margin calls in other markets. Silver, with its amplified volatility, absorbed the worst of the punishment. And in a move with profound implications for the dollar, Iran reportedly began charging Naira yuan-denominated tolls on Hormuz oil shipments. De-dollarization, weaponized inside a war zone. Section 7. The bear case. In full. I owe it to you to present the other side of this with the same seriousness I give the bull case, because any channel that only shows you one direction is not informing you. It's positioning you. The bears have legitimate arguments, and they deserve a full hearing. Silver climbed 150% to RTM1 in 2025 and another Hinos Tamigan 51% in early 2026 before the crash. SLV options volumes had reached levels comparable to the Nasdaq 100 ENUTs and S&P 500 EDNFs, the kind of speculative concentration that always or without exception produces violent corrections. Over the past 3 months, SLV has experienced net outflows of $215 billion. Suggesting institutional money is rotating out rather than buying the dip, eligible silver, while not currently available for delivery. Can be converted to registered if the price is attractive enough. The metal doesn't disappear. It waits. Recycling volumes increase with higher prices as scrap becomes economically worthwhile to process. New mine supply eventually responds to sustained price signals, even if the development lag is measured in years rather than months. And perhaps the most potent bearish argument right now is geopolitical. If Iran negotiations produce a ceasefire, the energy premium drains overnight, the Fed pivots back toward easing, and the entire monetary tailwind supporting precious metals reverses direction. The structural deficit argument, while factually accurate, has been a feature of the silver market since 2021 without producing the triple-digit sustained prices bulls have predicted. High prices are their own cure. The bears are not wrong about the risks. What they may be underestimating is the depth and permanence of the structural shift underneath. Section 8. The structural foundation. Because here is what sits beneath the noise. And this is the section I need you to hold on to, because it is the structural foundation that outlasts every margin hike, every geopolitical shock, and every paper price manipulation. The silver market has been in continuous supply deficit since 2021. 5 consecutive years. Cumulative shortfalls across that period total roughly 1,820 million ounces. almost equivalent to an entire year of global mine production simply missing from the system. Annual primary output sits at approximately 810 million ounces on deep weight. Recycling adds 180 to 190 million. Those are the only two sources of silver entering the market. On the demand side, solar panels, electric vehicles, electronics, medical instruments, and nuclear energy applications are consuming more every single year. The Silver Institute projects a 2026 deficit at 67 million ounces, marking the sixth consecutive year of structural shortfall. Where does the missing metal come from? Above ground stocks, vault inventories, private hoards, and those buffers are visibly shrinking. JP Morgan projects silver averaging at 18 Holland per ounce across 2026. The consensus range from ING, Saxo Bank, Bank of America, and HSBC sits between 55 and 70. JP Morgan and Deutsche Bank target gold at $6,000 to $6,300 by year end. The gold-silver ratio compressed to approximately during the Iran spike. And if gold reaches the $5,500 to $6,000 range, and the ratio compresses toward historical norms of 50 or lower, and the silver trend that mathematically cannot remain below triple digits. Section 9. The paper to physical abyss. The ratio of paper-silver contracts to physical ounces has been estimated at 356 to 1 356 promises, 1 ounce. London's LBMA, which operates as the global hub for spot silver price discovery. Overstated. Silver holdings by Tamain Tadais in Mainai Taida 300 tons per hour in 2021, an error that was officially attributed to a miscalculation, but that permanently scarred institutional confidence. By 2025, LBMA eligible silver stocks had contracted to approximately 155 million ounces, while annual floating demand ran between 900 million and 1.2 billion ounces. On day, the most telling indicator of London's stress is the Oxbow lease rate. Silver leasing allows central banks and major institutions to lend metal for a return. In normal years, 1 month lease rates sit comfortably between 0.3 and 0.25%. By January 2026, that rate had detonated to roughly 88%. So yes, when the cost of borrowing silver spikes to that level, it signals that holders are terrified of lending because they do not trust that the metal will come back, and their fear was validated. In October 2025, London was physically unable to deliver 1,000 tons of silver to India. The metal was simply not available in sufficient quantity. Section 10. The New World Order of Silver. The global silver market has fractured into 3 isolated pools. Agati. Asia. Anchored by China and India. North America. Anchored by COMEX. Europe, Mediterranean. Anchored by LBMA. Each pool is fighting for control of whatever metal it can source. And the old arbitrage channels that used to keep prices aligned across all 3 are broken. Silver is becoming something it has not been in modern financial history. Industrial metal, monetary metal, and strategic metal. All 3 simultaneously. And all 3 demand curves are rising while the supply curve cannot respond. Because new mines take a decade to develop, or grades are declining globally, and the world's dominant refiner just locked the door. The 4 structural forces converging on this market right now. 1. The credit crisis in paper silver. 2. China's export controls. 3. Central bank accumulation as part of de-dollarization. 4. Surging demand from nuclear energy and clean technology have never appeared together in the same cycle. That is not an opinion. That is a historical observation that anyone with access to the data can verify for themselves. Section 11. The 3 doors, and they all lead to the same place. The system designed to manage this market, COMEX, has exactly Three options. When delivery demand exceeds available supply. Option 1. Forced cash settlement, which destroys its credibility as a physical delivery market. Option 2. Raid eligible inventory by breaking storage agreements with private holders, which destroys its credibility as a custodian. Option 3. Halt trading entirely under force majeure, which destroys its credibility as an exchange. Every path leads to the same destination. Price discovery migrates east. Shanghai, Hong Kong, Dubai, markets where physical metal changes hands at prices the paper system refuses to acknowledge. Closing. Most people watching financial television right now believe silver corrected. They believe the system absorbed the stress, that the margin hikes worked, and the price decline proved the bears were right all along. They looked at the screen and saw red. They moved on. You didn't. You're looking at the volts. And those are not the same thing. The screen shows you a number. The volt shows you what's actually there. And the gap between those two realities is wider right now than at any point in the modern history of precious metals trading. The small number of people who understand the difference between a paper quote and deliverable inventory are the ones who have been quietly accumulating. While the headlines scream, crash. If you're one of them, you already know why this channel exists. If this is your first time here, subscribe because what unfolds over the next 48 hours, when April 1st notice day hits, is going to tell us whether 8 million ounces of registered silver can absorb another wave of delivery demand, or whether the system bends again toward cash settlement, and the credibility of Western price discovery takes another irreversible step backward. Type OG John AG 2. In the comments below, not because I asked, because you stayed for every data point, and you want this community to know you are here when the numbers still told the truth, before the narrative caught up. When the vaults are empty, what exactly is the future's price measuring? Invest with logic, never with noise. OG out.